operations. And so you can use that as well for the SBA 7A. Just to give you an idea, that's what 7A is, right? It's a multi-use SBA business loan, and it's probably the most, notable one out there, most popular. But you also have the SBA 504 loan, and this loan is strictly meant for purchasing fixed assets. So that is your machinery and your real estate. And typically, because you can use it for 7As as well, unless you use a 7A, a 504 loan only if the assets and machinery you're purchasing is going to provide you a large ROI, and you need to buy maybe a lot of them, right? So let's say you need to buy a fleet of trucks, right? You don't need to just finance one truck. You need to finance 10 trucks. That's when the 504 can make a lot of sense. Or let's say you need to, do a construction project on a building, say like an apartment building that's going to have 15 units and it's going to have an ROI, right? The whole explanation of why you should qualify is what will be the rent roll once this building is acquired. This is when a 504 makes sense, and oftentimes it makes sense to use 504 also because you can usually combine a 504 through an SBA lender for a portion of the funds, and then you can also use a conventional lender in case the dollar amount you're going for is over $5 million. And so both SBA 7A loans and 504s, the max dollar you can get is $5 million. And so that's why 504, if you're buying assets that are worth more than five, they can make it work with a creative way where they essentially have a conventional lender collaborate with an SBA lender to front the funds and get the client approved. Now, another loan that's popular is an SBA micro loan. So, sticking to its moniker, it's a micro. It's very similar to the SBA 7A as far as the terms, but the big difference is it's just limited as far as dollar amount. It's usually anywhere from $15,000 to $50,000. And as a business owner, you would apply for it for a couple of reasons. You might just not qualify for a 7A for a bigger amount. You might be, a very new business, maybe like under 3 years in business. You also might just need a smaller amount. You don't need that much. So why would you go through a harder, longer process, more paperwork? Go for your micro loan. It'll be faster, in and out. And so that's your micro loan. And then you have your what we can call your disaster assistance loans and grants. So there's always new products coming out for this. Some notable ones are the SBA EIDL, the PPP, the ERC, and there's also programs for women-owned small businesses and minority-owned small businesses. And so usually this option, disaster assistance / grants are going to be different in the sense that they're going to be way better in term, right? They're going to be almost free money, if not free money. For example, you have the EIDL loan. This loan was a 30-year term at a 3% rate. And so it's very important to distinct, the differences between that and an SBA 7A, because if you're a borrower looking for SBA and you're stuck on 3% 30 years, but you're not going through a disaster, right? You're not going through a pandemic, you're not from Los Angeles in a county that got affected by fires, you wouldn't qualify for an EIDL, right? Same thing with, the PPP and ERC. These loans were strictly meant for business owners that were operating through the pandemic with employees on W-2 salary, right? And so that's very important to understand. Also, with these loans, right? You ever heard of the saying, there's no such thing as a free lunch? With these loans, they're usually sometimes much longer wait times, much more paperwork requirements to get approved for it. So sometimes you might qualify for, say, close to free money, but you also need the money for a time-sensitive need, right? You're not just applying for capital because you can get it. You need to get something done by the summertime, right? So you can, service all those contracts that you have, all the work you have coming up. So you keep that in mind. The disaster programs, they will give you better terms, but they might not be as straightforward as far as the process. ERC is a big one, right? When you have almost free money on the table, everyone's applying for it, right? So now it's longer wait times. There's people that apply for the ERC, which is Employee Retention Credit, during COVID pandemic. They qualified for it, they got approved for it, and we're now in 2025. The pandemic was in 2020, 2021, 2022, 2020, right? And they still haven't received their ERC. Let's just give you an example. All right, so next thing we're gonna go into is SBA no-nos or deal killers. All right, so SBA loans, right? Like even if from the disaster products to just the standard 7A, they're gonna be toe-to-toe better than everything else out there you're seeing, right? And so it's important to understand that there's going to be strict requirements, right? The complexities. So there's something called an SBA SOP, right? Which periodically changes. This means the standard operating procedure of the SBA. So since it is a government organization that administers the loan, it's definitely going to be a regulated loan by the government. So there's certain guidelines within the SBA SOP which updates that will tell you, what qualifies and what doesn't qualify for an SBA loan. So if you work with a broker like Lexington Capital, we'll be able to hold your hand and also just give you the information you need to know, about this loan, about what you can do, and if you can qualify. So some notable SBA SOP, rules of thumb is, one is that you need to be a permanent resident, right? So what qualifies as a permanent resident of America? You got to be either a U.S. citizen or you got to be a 10-year green card holder. Okay. So there's different forms of visas of people traveling to America. There's investor visas, there's temporary green cards, and these kinds of things are never going to be 10-year terms. They're going to be something like 2 to 5 years. So your green card needs to be on a 10-year term to be considered a permanent resident. All right. And they actually just changed this June 1st per the SBA SOP, where before that, non-permanent residents were getting access to SBA, but now they're no longer allowed. All right, that's just one rule of thumb. Another rule of thumb is merchant cash advances. Formerly, you were allowed to refinance them for an SBA loan, pay off a merchant cash advance. Now you're not allowed to. And if you're wondering what a merchant cash advance is, this is a form of alternative financing where it's much more lenient to qualify. It's very minimal paperwork. It's fast funding. Oftentimes doesn't require, good credit, if any credit at all. And a lot of borrowers were getting them, and they're all shorter term by nature, higher interest. People were getting them and then getting SBAs to clean it up. But what happened is people were, either defaulting or coming back and getting more merchant cash advances after the consolidation. So those are no longer allowed to be consolidated. That's another rule of thumb. Another notable one is, if you have any active SBA defaults or error codes, compliance issues within the SBA system, that's going to be a deal killer too, right? Because if you are flagged in the SBA system that you have anything like that, it's going to have to be resolved in order for you to get another SBA, right? You're not going to be able to slip it under the rugs. Maybe some conventional lenders don't catch things in background. When you're going through SBA, all things SBA is all showed in the database. The lender will catch it, all right? And then another rule of thumb that's notable is that for the SBA SOP, you have to wait 90 days to apply for or to qualify for another SBA loan upon the most recent SBA that you've gotten, right? So right now it's, June 5th? June 25th? Today is June 25th, right? So if you just got an SBA loan today, June 25th, you technically wouldn't qualify for another one until September 25th, right? So very important to understand SBA SOP. Another rule of thumb is ownership, or who's going to be a guarantor, a part of ownership of the business on the loan, right? So SBA loans do require a personal guarantee on, the applicant of the loan, and anybody that owns 20% or more of the business will have to be a personal guarantor. All right, so this comes into play as far as just them being liable for the debt, if you ever defaulted, but also just as far as qualifications, right? If the lender has a certain credit requirement and you have one owner that's, say, 60% that has an 800 score, you have one owner that's a 40% owner that has a 500 score, they both will typically need to have that credit score requirement to be able to qualify. So know your profile, know if the 20% owner or more are all willing to be a guarantor, before you apply for your SBA loan. And so another one is NAICS codes, right? So every business, when they file taxes, they have to file under a NAICS code, NAICS. So it can also show on your taxes labeled as business activity code. And this is essentially what classifies the industry that your business is in, right? So a lot of business owners switch NAICS codes, after opening the business, or a lot of them, cross-sell other services, right? But it's not what their NAICS code says. It's really a matter of what the NAICS code says on your taxes. So there's certain NAICS codes that are restricted. There's even certain franchises that are restricted to getting SBA. So you want to make sure you're keen on, if your NAICS is restricted, or or if you're a franchise that's restricted to get an SBA. But regardless of SBA SOP, know your NAICS code. If you sell, ice cream on the side, but on the NAICS code it shows you're a trucking business, that's how you're going to be applying as a trucking business. All right. So that's the NAICS code, and then that's the SBA SOP. There's a lot more to it, but those are just some notable ones about it. And so back to no-nos and deal killers, right? So obviously anything that's against the SBA SOP, that's a deal killer. You wouldn't be able to apply for the SBA. Another one is just your background, right? So any SBA lender during the approval process, they're going to look into your background. They're going to use third parties to search it. They're going to be looking for, have you filed bankruptcy recently? They're going to be looking for, do you have criminal record, right? Do you have any felonies, especially recent, right? And what was the felony? They're going to be looking at open lawsuits, right? Anything that's like liens against you as the owner or the EIN of your business, right? So somebody either suing you as a civil judgment or it's a business litigation, if there's anything actively open in court, even if you're not guilty, the SBA process will be halted. They will not allow you to move forward until that is settled or just out of the courts, right? So that's the background. And then as far as bankruptcies, you can get an SBA loan if you file bankruptcy, but rule of thumb is it needs to be discharged at least 3 years ago. All right, not filed, but discharged. So you can file a bankruptcy, but sometimes it can take several months, if not years, for it to be discharged. So you got to know that, going in, those would be deal killers as far as the background. And then another one is taxes, right? So if you owe taxes and they're on a payment plan, you can qualify for an SBA loan. If you owe taxes and they're not on a payment plan, the IRS is going to file a lien on, whether it's your personal tax you owe or a business, there's going to be a lien on, one or the other. If you have an active lien, it's going to get treated the same as an open lawsuit, disqualify for SBA loans. All right, so more deal killers. This is an add-on to, the whole criminal activity thing or felonies. It depends on the crime, right? So, automatic deal killers if you have recent felonies, right? If you're currently in arraignment, getting convicted, on trial, on parole, on probation, you're not going to qualify for an SBA loan, right? But let's say it was a former conviction, a former felony, right? Usually you want that to be at least a year ago, right, to be safe. Ideally, probably even more than that. But the type of crime you committed is going to be pivotal. All right. So crimes that are considered, of moral turpitude, such as, violence, manslaughter, homicide, such as financial crimes, security fraud, bank fraud, wire fraud, things that make it is a question of your moral character, will always get you probably declined for the SBA loan. Now, there are certain things that you can reason, right? Let's say you had a DUI, or let's say you had a drug charge, maybe you had drugs on you, maybe you had, a bad addiction in the past, right? Maybe it was just a misdemeanor, right? Those kind of crimes are usually okay, as long as you can explain what happened, show that you were genuinely remorseful, obviously show that it's not going to happen again, you can usually get approved. But the automatic deal killers will be the ones where it's moral turpitude, right? So, really bad crimes, trying to kill somebody, trying to hurt somebody, violent crimes, or financial crimes, right? Financial fraud. That will get you declined. And even with bankruptcies, if you get discharged, if you had to discharge bankruptcy within 3 years or more, you'll get approved. Same thing, you might just need to explain, what happened. All right? So that's another deal killer that, just as far as crimes. Now, credit score, you typically want to have at least a 600 credit score. If it's below that, very rare cases you'll get approved. Typically you got to either, make up for it with a combination of collateral and just really profitable taxes showing that your business cash flows very well. But below 600 credit score, might be better off, looking to other options. And then other deal killers is just, low to no revenue, right? Especially if it's not a startup business you're applying for, it's just, existing business, but there's, barely any revenue, if not any. Maybe you had a year off, right, and you showed $0 for the year, you're not going to qualify, right? Or if you did do revenue, but let's say you're behind on your taxes, right? You haven't filed taxes. The IRS or the SBA goes to pull transcripts of the IRS. It comes back, nothing is showing on the record. You won't be able to qualify for an SBA loan, regardless if you have a tax return copy. It needs to be filed within the IRS officially. Regardless if you have bank statements showing revenue, you need to have taxes. They're going to approve you based on your taxes. All right. Now we're going to go over SBA 7A loans a little bit more specifically now, because this really is, the most popular and probably the most, indiscriminate SBA product, because they allow you to use it for so many different things, right? So you can use it for, working capital. You can use it for, refinancing debt. You can use it for, acquiring machinery and assets, commercial real estate. You can use it for a startup business that's brand new or a startup franchise. You can use it to buy a business, right? So this is the SBA 7A product, and we're going to break it down within two different types. All right, so they're all under one umbrella, SBA 7A, but just to make it less confusing, you have your SBA Streamlined 7A, and then you have the SBA Full Underwrite 7A. All right, so full underwrite, right, and streamlined. One's faster and easier, one's harder, and underwrite is, what the back end people within, any bank, their job is to review documents, review financials, and essentially qualify, a merchant. So there's a lot more review, right, a lot more paperwork for a full underwrite. So distinct differences between the two. Streamlined is going to usually require higher credit scores and you'll be capped as far as the dollar amount. You can normally get up to $350,000 for a streamlined SBA. Now you have your full underwrite SBA. You can typically get away with a lower credit score, but there are going to be more requirements, such as profitable taxes, such as collateral, such as equipment collateral, such as just being able to provide more financials and using a CPA to provide stamped certified financials. So this is your full underwrite, and it's really more suitable for a business owner that is looking for 350K to 5 million, your SBA 7A max. Or let's say you went for the streamline, but your credit score is too low, then you'll have to go the full underwrite, harder process to get the same dollar amount. All right, so we're going to go into the streamlined SBA, to start off as far as SBA 7A. So this product is really mainly for working capital, as far as the use for the capital. So it's not really necessarily a multi-use. Well, it's definitely not a multi-use, SBA. Some lenders allow you to refinance debt with it, but generally speaking, is really meant for working capital. So this is your day-to-day operations, your rent, your marketing, your advertising, utilities, your payroll, things of that nature. This is what working capital is for. All right. And then they do require higher credit scores. Typically you'll see them require anything from, a 670 to a 700 plus in order to qualify for this product. And just know that, on timing wise, you're probably looking at two to 4 weeks to get you funded. And that's pretty much the SBA Streamline 7A. Now you have your SBA 7A full underwrite. Timing wise, you're probably looking at anywhere from 30 to maybe even 90 days of a close. And the requirements are a lot more stringent. Well, just so you can understand, the difference, so SBA Express, not Express, the Streamlined, they don't really require profitable taxes per se. It's going to really be more based on gross sales, credit score, the higher credit, right? But now you have the full underwrite where you can get away with a lower credit score, let's say as low as a 600, 620, 640, 650, but now they're going to be crunching the cash flow. All right, so when you file your taxes, you have your top line gross revenue. Let's just say you did $100,000 for the year. Then you have your bottom line net income, right? This is the number that you get taxed on. After all your expenses, your deductions, this is the amount that is what your business shows that you made for the year. All right, so let's say the loan you're applying for, costs $1,000 a month for the monthly payment. Let's say you only showed $1,000 on your taxes in net income, right? That wouldn't qualify, right? Because a $1,000 loan payment times that by 12, you're looking at a $12,000 yearly payment. This merchant is better off looking at a streamlined SBA where the gross or the net profit isn't as important. If they can compensate it with the higher credit, that's a better fit, right? Because now they can get approved. All right. But let's say they do have the profit for it. That's how they crunch those numbers. Now, let's say they're going for a huge dollar amount, over $350,000, right? Which is really what it's more suitable for. SBA loans over $350,000 do require personal collateral. All right. So the lenders will always target, personal real estate that you own. So they want to see your primary residence as the collateral. If you don't own personal real estate, they'll look at rental properties you own, investment properties you own. If you don't have that, they can sometimes get creative and look at the equipment you own. They'll put a lien on the titles of your equipment. They can look at stocks or bonds you own, right? What's the dollar amount of the liquidatable assets to your personal name? They can look at the cash value in your personal life insurance policy. If you have a whole life insurance that has cash available, that can also be a creative way to get collateral. And the main reason for collateral is essentially to match the loan amount. They'll usually want to get enough collateral where the principal loan amount is covered for that financing. And as far as the personal collateral, the reason why they target personal first is because they want to see that you have skin in the game. The SBA loan process, not the process, but the term is a 10-year term, right? So it's a long term by nature. They want to make sure that you're not taking this loan just to run. You're not taking this loan just to, ignore your business, right? Now you covered all your bills with your loan, and now you can just go on autopilot and not really, operate your business anymore. So that's why if they know your house is on a 30-year mortgage, they know you're very likely to stick around and see it through, that the business gets the ROI, return on investment, on that SBA loan. All right, so that is your SBA full underwrite. And so main differences, right? Let's just summarize it. So your SBA Streamlined, you're going to be capped at usually $350,000. It's going to be a faster process, 2 to 4 week close, less paperwork. You won't be required to provide the collateral, your personal real estate. It's going to require higher credit, but won't require profitable taxes. And that's your, SBA Streamlined. Now you have your SBA 7A full underwrite. It's going to be a longer process, 30 to 90 days. There's going to be more requirements, more doc requests, more financials. They're going to require profitable taxes to service the debt that you're going to be paying, right, on a monthly basis. And then if you don't have profitable taxes, or you don't have enough profitable taxes, or if you're just applying for a big enough loan amount, they're going to require, collateral within your personal real estate, your rental real estate, your investment properties, your equipment, your personal liquidatable assets. Okay, so those are the main difference between the two products, and also the use cases, right? Streamlined SBA is really meant for working capital and sometimes debt refinance, and then SBA 7A full underwrite is really meant for all of the above. Working capital, debt refinance, purchasing assets and machinery, purchasing commercial real estate, purchasing a business, purchasing a startup business, purchasing, what else you got? That's pretty much more or less what it is. And the cool thing about SBA 7A full underwrite is if you can make it make sense, you can usually wrap all those different uses into the same loan, which is also why it's a very popular option. Let's say you do prefer a faster option, right? A streamlined SBA, but you also know that within the next 12 months, you're going to need to buy machinery and equipment. You're going to need, maybe a line of credit for extra working capital. You're going to need, maybe a building, right? At that point, it just makes sense to wrap it all into one note. Yeah, it'll be a longer process, but now you get your best bang for your buck. You send all that paperwork and you get the deal funded, and now you're good to go for the foreseeable future, right? So this is why the SBA 7A product is really cool, because there's not much loans like that out there. If you cash out your property, oftentimes the lender will be very strict on what you're using the capital for. You might not be able to use it for all the things you need it for. Same thing for conventional financing and so on and so forth. So this is where the SBA comes into play. Just extremely flexible, as far as what you can do with it. And so we're going to have a side note and get into as far as the acquisition of machinery and assets. All right, so we want to talk about real quickly commercial real estate for the 7A full underwrite. So let's say your goal is to acquire a building for the business. Within the SBA loan, you're not allowed to buy buildings that are investment properties. So you can't just say, hey, I have a very successful construction business, very profitable, a lot of cash flow, and I want to go ahead and buy a property to Airbnb out. That wouldn't work, right? They need that building to be occupied by the business by at least 51% of the square footage. So it's really ideal for someone that's looking to have a space for their actual operations, right? So if you're a construction company, maybe you need a space to put all your equipment, right? Or a trucking company, maybe you need a space to park your trucks, right? Or maybe if you're an auto repair shop, you've been, renting for the last 10 years, you plan on being around for another 20 years. Now it makes sense for you to go ahead and own that building, and you're paying, mortgage towards equity instead of going towards rent, right? So commercial real estate acquisition needs to be occupied by the business. It just can't just be random real estate you're just buying just to make real estate moves. That you're better off going, either hard money, or just, opening a separate LLC to do that, or personal, mortgage. All right. And as far as requirements, that's different. The one difference is with any acquisition in general, there's going to be down payment requirements. All right. So for a commercial real estate, building acquisition, let's say you found the right building, your business is going to move in, they're going to require a 10% down payment on the principal loan amount. And so let's say, it's $100,000. That means you're going to owe $10,000 at closing in order to fund that deal. And if you compare this to conventional lenders, right? Your Chase Banks of the world, Bank of America, Wells Fargo. You're welcome, Bank of America, Chase, and Wells Fargo, for the advertisement in this video. Those lenders will typically, on average, ask for 20 to 40% down payment. All right. So if you're, especially if you're a startup business owner, or you're just needing the capital, your cash reserves for other reasons, SBA makes all the sense in the world, because now you're going to be able to save anywhere from 50 to 200%, right, on the down payment requirement. All right. Now you have your business acquisition loan, and this is a loan where you can be an existing business owner or not, and you can use the SBA 7A product to buy an existing company that's successful and be the owner, be your own business owner, right? Be an entrepreneur. Similar down payment requirement, you're going to need to put up roughly 10% of the principal loan amount. And so same thing, if you go to a conventional lender, they're probably going to ask for 20 to 30%. SBA will give you a better bang for your buck, and more reliable product to the government. And on top of the acquisition, the 10% down payment, you're going to also need to have some sort of transferable experience, right? So That can be within a already existing successful business, and you're showing that you have management history managing a business. You can also have just direct industry experience, right? If you are a swimming pool instructor the last 30 years and you're buying a swimming school, that's a good fit, right, for an acquisition. The only type of acquisition that you're not necessarily going to need, transferable experience are franchises, right? Because franchises, they come with a proven model, proven profit, proven system. That one you can usually get away with it, just as long as you can, qualify in the other ways, right? The cash flow of it. And so now let's just focus real quickly on the acquisition and startups, right? So we'll go with startup real quick. So startup, this is when you're just starting a business from the ground up, right? You're not buying a brand new business. This can be within a franchise. You're starting a franchise from scratch, or you're just starting your own business. You thought of your own idea. This one's probably the most difficult one to apply for. So you really want to make sure you have your ducks in a row. The down payments are going to be usually higher. You're going to usually be required to put up, 20 to 25% of the principal amount. And if you happen to have invested into your business already before the launch, let's say you already bought equipment, you already hired people, you already put a down payment on a lease, maybe you already made a few months of lease payments. As long as you can provide receipts, you can typically, report majority of those investments as owner equity investment. So if you already covered 5% of the 20% down payment through owner equity investments, you can provide receipts. Then you're only going to be required to provide, the difference at the closing table for a startup loan. And so that's your startup, right? So now as far as startups and acquisitions, well, actually not startups and acquisitions, startups and acquisitions. Well, that's pretty much covers it, right? You got your down payments, you got your requirements. One thing you should keep in mind too is that any of these loans, the SBA 7A, they're going to look very closely as far as like how much cash you have on hand, right? Before and after close. They'll call this, pre and post close liquidity. So you have a lot of situations where, a borrower can scrape together all the funds to make the deal happen. But then in order to make the deal happen, they have $0 left in their bank account. You probably will get declined if that's the case, because they still want to see you have money in the bank account so you can afford your loan, right, on the payback. And so a creative way you can, pretty much make up for that is through gifts. You can take gifts. SBA will accept gifts as long as you can show that the money is in a bank account, it's available. You can use gifts. So you can have friends, families, other businesses just write you a gift note, and as long as everything's legit and on paper and documented, you can use that to get you approved as well. All right. So that is your SBA, 7A streamlined, SBA, full underwrite 7A. All right. Very complex, very nuanced. This is why you want to make sure you get your ducks in a row, before you apply for either, because, you might not qualify, for what you want, or you might qualify for a different program than you thought. Right. And so now we're going to really quickly go over the common documents and stipulations for any of these SBA loans. All right. And so you have your 1919 form. This is just a uniform, universal SBA application that any of these products, whether it's the 7A, the 504, the micro loan, the full underwrite, the streamline, you're going to have to fill it out. Very easy form. It's just a basic application that makes you fill in your personal information, your business information, answer some questions, right? And, yes or no questions. That's your SBA 7A, 1919 form. So, don't be overwhelmed by it. It's just very straightforward. Just answer it honestly, and that's how you take care of that. Another document that is very common for SBA for all of these will be a personal financial statement. And so a personal financial statement comes in different ways. There's many different templates out there for them. Most banks have their own template. And so with the SBA, they have their own called the SBA Form 413. And this is pretty much a breakdown of your personal assets and personal liabilities. So your personal assets would be, real estate you own, automobiles you own, liquidatable assets you own, like stocks and bonds, cash value life insurance, your income, your W-2, right? Income, your rental income, your investment income from dividends, any capital gain income you get from your business, the profit you make that you pay yourself. This is your assets. Then you have your liabilities. You have, your auto loans, your mortgage notes, your personal notes, personal loans, personal credit cards, anything miscellaneous, right? If you say you owe somebody a monthly payment for something, this is your breakdown of your personal assets and liabilities. Again, you just want to be honest about it. Just fill it in thoroughly. And this way you don't have to go back and forth, with your lender. Another form that is very common for SBA loans is the business debt schedule. And so this is where he's going to list the existing debt that your business has. You're talking about your commercial real estate mortgages under the business EIN, any equipment financing loans under the business EIN, any bank loans or lines of credits under the business EIN, any existing business SBA loans under the business EIN. This is your business debt schedule. Usually for your streamlined SBA, right, not as important because the cash flow is not getting crunched as much. Your full underwrite SBA 7A, super important that those numbers are on point because this is how they're going to really crunch your cash flow, right? They're going to be looking at the net profit on your taxes, the monthly payment for the loan you're applying for, the monthly payments of all the loans you currently have. Will it all make sense if you put it all together, right? Another form that's very common, obviously, is your tax returns, right? For any of these products, they're going to be asked to provide anywhere from 1 to 3 years of business and personal taxes. And then typically for the 7A full underwrite, not the streamline, they're going to ask for a year-end profit and loss balance sheet. Year-end means, from year to year start, year to the end, summarizes the whole year. This is usually relevant if let's say you filed extensions on taxes, right? So right now we're in, 2020. So right now we're June 2025. They're going to want to see from January 1st to June 2025, right? What is the profit and loss, income and expenses? What is the balance sheet, assets and liabilities? All right. So those are your year-end and year-to-date financials. And then another common document, not for streamlined SBAs, but for the full underwrite 7A, is business plans and projections. All right. So they're going to want you to provide a business plan, which will essentially summarize, what your plans are with this capital, what the overview is, right? Why you're doing this, what's the competition like? Why you're different from the competition? Why this is going to make sense for you? What are all the X factors within your business that only you as the business owner can explain better than us just the bank trying to guess what you're going to do with the capital, right? Every business is different, and then your projections will be your expected financials for the next 3 years, right, during the payback of the loan. So ideally, you want to see that in chronological order, the income gets better, the profit margins get better, and by year 3, it should be looking like this. And that's how you get approved with your projections and business plans. Typically, if you're going to be planning for a decent dollar amount, you're probably going to want to hire a professional to do this, just to ensure that all your ducks in a row, that you don't get declined, of course, and that it makes sense on paper, right? Especially if it's a huge loan. Let's say it's the max $5 million. These people that do these projections and business plans that you can hire, this is what they do for a living, right? So the professionals, they're probably much more, privy at getting a $5 million explanation of use for capital because this is what they do. They've done it multiple times than you as a business owner who likely have never applied for $5 million before, right? So those are your business plans and projections. And then some other common documents you're going to need to provide is insurance. So for any of these SBA loans, they're going to need insurance documents. So general liability, any business that's operating will need a general liability insurance. It just covers, the business in case anything happens, to the business in general, right? So you're going to need to provide that. And then what you got to do eventually, if you get approved to go into closing, you got to list the lender as a certificate holder, which is usually super easy. As a borrower, all you got to do is just call an insurance company. They add it on same day. It's pretty easy, but that's bare minimum requirement. Obviously, if you don't have general liability insurance, you're going to need to enroll in one to be able to get the SBA loan. And then they're going to also require for miscellaneous insurance documents, right? Flood insurance, only if it's applicable, right? If you're in the area that gets affected by floods, you got to provide that. You're going to have to provide workers' compensation insurance, only if it's applicable. If your business has 0 employees, you don't need to provide workers' compensation insurance. And then you're going to need to provide business personal property insurance. And this just covers your business assets, in the event of something happened to them. And this is also going to be required across the board. Also gonna have to list the lender on these as well as a lender's loss payable, for these different documents that are applicable. All right, except for workers' compensation, you don't need to list anything on there as far as the lender. Another document that is always required is a business bank account. All right, so an SBA loan would not be able to fund a personal bank account. So you got to be able to provide a business bank account that's active under the EIN of your company, showing the legal business name of your company or the DBA. And eventually, if you get approved, they're going to ask you for bank wire instructions. So you're going to have to provide instructions for the lender to be able to fund you, right, with routing number and account number. And you also have to be able to provide a voided check to match that as well. And then most of the time you have to provide business bank statements, right? Same thing to match everything across the board. And then you also have to provide corporate formation documents, right? So this will be your EIN letter, articles of incorporation. If you're an LLC, you have to provide a operating agreement. If you're a corporation, you have to provide a corporate bylaw. And those two documents, the operating agreement and bylaws, if you don't have it, don't fret. You can literally just make one online for free or pay a service online and do it for you. And that's not a problem. You can always do that last minute. But everything else, you should have an EIN letter. You should have an articles of incorporation. And if you don't, you got to definitely find one in order to proceed with your SBA loan. And next thing that you're always going to need is form of identification. So you got to provide your driver license, an active driver license. And then a lot of times they're also going to ask you for a secondary form of ID as well for extra verification. So that'll be, a passport, or even they can accept a personal credit card. And then if you're a U.S. green card holder on a permanent residency, 10 years, you have to provide your U.S. green card, and also secondary form of ID such as a personal credit card. Sometimes they can even work with some sort of ID if you work somewhere, things of that nature. All right. And then another common requirement for SBA loans is letters of explanation. So let's say you are a clean background, you don't have recent bankruptcies, you don't have recent felonies, you don't have recent lawsuits against you, but you had a lot in the past, right? The lender will oftentimes ask for just a letter of explanation, just a brief write-up, but what happened, why you regret it, and why you weren't able to do anything about it, right? So a good example is coronavirus, COVID-19. A lot of business owners went out of business, may have defaulted on SBA loan, maybe filed bankruptcy, maybe had liens filed on them, maybe they fell behind on taxes, but then they ended up resolving it later. You explain, right? I went through hardship. I went out of business. I couldn't make payroll. I lost all my employees, and usually that will get you approved. But obviously, if your explanation is not something like that, I ended up going on vacation and just neglecting my business. I, didn't want to pay it, right? Somebody stole my information and applied around, and my identity got ruined. Usually that's going to be a bad look because it looks like you just don't have control over your situation, or you just aren't trustworthy with financing, right? So just make sure that you understand that, letters of explanation, you can usually overcome, pretty bad things in the background as long as you, make it make sense. All right. So another thing I'll get into is just competing offers for an SBA. So, oftentimes when we come across a borrower that's looking for an SBA, you always want to give them the whole perspective, right? Which is also, why I mentioned earlier, we offer all forms of financing at Lexington Capital, right? So, you have other options out there to compete with an SBA. You have conventional term loans, right? Your term lenders, if they can approve you and you qualify for an SBA, a term loan will typically be faster than an SBA, but they will be shorter term, 3 to 7 years. So if you need something faster, it can make sense for you to do a term loan with a conventional bank. There's also your merchant cash advances, right? The alternative finance industry will oftentimes approve you just based on 3 bank statements, right? And you'll get funded within 24 hours. And just so you know, term lenders, conventional, will usually fund you within 1 to 4 weeks. But alternative financer, like an merchant cash advance lender, will usually fund you within 24 hours. So if you need something that's even faster than a term lender, you should go for an alternative finance because SBA will give you a better term all day long. But if it's time sensitive, you don't have time to wait 2 to 4 or 5 weeks or even longer. That's when your alternative finance will make a lot more sense to compete against the SBA. And so keep that in mind. And then you have your mortgages and HELOCs, right? That's probably the last thing that can compete with an SBA, where it's a 30-year term, 5 to 8% APR, maybe even lower. So it's going to be a longer term than SBA. It's going to be a lower APR than SBA, but it's apples to oranges because it's not always going to be a business mortgage or a business HELOC. And so you have to have that question to yourself, are you strictly privy on the terms? and the monthly payment being the lowest and the lowest APR, and you're okay with having a mortgage go on your personal credit report and on your DTI, or putting your house up, if you're okay with that, then a mortgage or a HELOC can theoretically compete with an SBA and give you a better deal. And so that's what you keep that in mind. And overall, this is the SBA product. There's a lot more we can get into, but this is just an overview. And reason why it makes sense to use a broker, is because of the fact that it's so complex, right? There's so many ways you can go. You can actually go on SBA.gov, and there's a tool called Lender Match. And if you plug in your basic information on there, it will match you with 20 different lenders. You can go on Google and look up, best SBA loan lenders in America. It'll show you, top 20, top 15 producing SBA lenders. And the reason why you'll use a broker is because oftentimes every bank is different. One bank might work with construction, one might not. One bank might work with trucking, one might not. One bank might only work with the West Coast, one might work with the East Coast, right? One might require a certain amount of employees, one might not. One might be a streamlined SBA lender where it's capped at 350, one is not, right? So the reason why you want to use a broker is because we'll be able to help guide you, right? We'll place you to the right lender. We'll introduce you to a lender that we're familiar with, we have a relationship with, so the trust is already there. Your information protected, and you'll ultimately just have a much more convenient process, than just trying to guesstimate it on your own, right? And so that's the main reason why you want to use a broker, is because the product is so nuanced. It's not one glove fits all. It's not black and white. It's definitely a lot of gray area. And also the broker is going to be the least biased person to give you the SBA loan, right? Because if you're dealing with strictly an SBA banker for an SBA loan, that banker will try to make that deal work as best of his ability before giving up on it, right? So if it's not a good fit, you don't have the profit there, and you don't want to use collateral, they might not tell you they need real estate until the end of the process, right? Because that's the only thing they can offer you. So you might go through 30, 45, 60 days of work, and then they say, you know what, you show a loss on your taxes, which I knew right from the start, but I didn't tell you, and I'm going to need something to make up for that. I'm going to need you to put your house up. Now you're 60 days in, and now you found out you had to put your house up, right? So you might have lost out on the opportunity, right? Because you're so committed. And so this is why you use an SBA lender. into that more, and we'll make sure we get you a better answer for that one next time. All right, so we're all set for this episode. So thank you guys again for joining. This was a pleasure for me, myself. My name is Travis Tang. I am the director of the SBA program with Lexington Capital. And if you enjoyed this video or you found it helpful or informative, definitely just drop a like, drop a comment, share this. Whether you're a business owner or you're a broker helping your business owner, navigate the world of finance. This is what we're here for, to help you. And so tap in with us, Lexington Capital. We're going to have more on the way. And any questions that were not answered, like I said, just drop them below. Reach out to us. We're everywhere. Facebook, LinkedIn, Instagram. We have a website. You can apply through there. YouTube, the whole 9 yards. And that is all. So thanks again, and we'll see you on the next one.